Hi, and welcome back to the Food Fund. In this video we will be analyzing if Diageo stock is a buy. Diageo, stock ticker symbol DEO, is just one of many companies we explore on this channel. The Food Fund is focused on all things related to investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. We have a lot of awesomeness to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Diageo. Diageo was founded in 1997 by the merger of Guinness and Grand Metropolitan. The company is headquartered in London, England, and has operations in over 180 countries. Today, Diageo owns a portfolio of over 200 brands, including Johnnie Walker, Smirnoff, Guinness, and Tanqueray. Sounds tasty. Let's take a look at the price action. Starting with the 1-year chart, we see that Diageo had a CAGR of about -8%. Zooming out to the 5-year chart, we see that Diageo had a CAGR of 2%. Diageo price action has been slowly climbing in the long term but falling in the short term. If we perform a backtest comparison of investing $10,000 in Diageo versus the S&P 500, we find some unsurprising results. In that comparison with the S&P 500, $10,000 invested in Diageo would have generated $11,738 or a 2.8% CAGR versus $17,654 or a 10.4% CAGR if invested in the S&P 500. Keep in mind that these values include any potential dividends reinvested. Diageo was clearly outperformed by the wider market. A Diageo investment would have been much more volatile as well, with a 19% standard deviation, a measure of volatility. Despite both the best year and worst year performance beating the S&P 500, Diageo max drawdown of 29% outweighs the S&P 500. Diageo also underperforms the S&P 500 in comparisons with a Sharpe ratio of 0.15 and a Sortino ratio of 0.23. Sometimes just owning the market is the better option. Let's take a look at the fundamentals to find out more. Gross margin is 60%. This is pretty high and indicates the strong brand value of the company's products. Revenue has compounded at around 7% over the past 5 years and has reached nearly $21.7 billion most recently. Good revenue growth and great gross margins make for a decent start to this analysis. Looking at operating cash flow, we see a -2% CAGR over the last 5 years, while capex has grown at a CAGR of 15%. As a result, free cash flow has fallen at a -8% CAGR. Diageo is in bad shape. Operating cash flow is falling while the company continues to spend an ever-increasing amount of money on capital projects that do not seem to be reviving operating cash flow growth. Weighted average shares outstanding have been decreasing at about a 2% CAGR, going from 2.43 billion shares in 2019 to 2.27 billion shares most recently. Diageo is buying back shares. Given the falling free cash flow, it is unclear how these share buybacks can be continued going forward. Now let's view return on invested capital. Return on invested capital has increased from 12.5% in 2019 to 14.5% in 2023. Though the return on invested capital is fairly low, the increase over time points towards improving efficiency. But this is puzzling. How can return on invested capital be increasing while free cash flow is decreasing? There may be something else going on here. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 345 days in 2019 to 306 days most recently, Diageo has gotten a comparatively more efficient managing inventory and supplier relationships. However, the cash conversion cycle value is high, but there may be a reason for this. Last, let's explore Diageo's debt. The net debt to EBITDA is essentially unchanged, going from 2.6 in 2019 to 2.7 most recently. This is neither good nor bad in my opinion. Less debt and more earnings is always better, so we'll look for Diageo to further drop this value in the coming years. The fundamentals of Diageo are very curious, especially around the diving free cash flow. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Diageo. It is a beverage company with a gross margin of 60%. The 5-year revenue per share CAGR is 9% and the 5-year free cash flow per share CAGR is -6%. This fits with what we know about the share buybacks improving per share metrics at the company. A return on invested capital of 15% is pretty decent and it has been increasing over time. Next, the cash conversion cycle of 306 days is high but seems to be normal for alcohol and spirits companies. Concerning debt, a net debt to EBITDA of 2.7 means that Diageo could pay off all of their debts with over 2.5 years of earnings. So from a fundamental standpoint, Diageo actually raises a few questions. Now let's switch our attention over to valuation. Diageo is undervalued relative to the S&P 500 with a ratio of 0.8. The price to earnings growth, or PEG ratio, is 2.5, which means that Diageo is overvalued compared to its projected earnings growth. Diageo has had a very rough go over the last few years. The share price has been unremarkable against the wider market while the fundamentals paint a conflicting picture. On the one hand, revenue continues to steadily march upwards and the high gross margin generates significant gross profit. But from there the story falls apart. Operating cash flow continues to be pressured year after year while the company has decided to spend more on capital projects. Management needs to be very clear on the return prospect of such investments and should consider pulling back on capital spending. Regardless, they should definitely cut operating costs because even if they were not increasing capex spend 15% per year, free cash flow would still be negative. Diageo still has a few fundamental issues to iron out before this becomes a buy for me. For these reasons, Diageo is not going on the watch list. Many thanks for watching. What do you think about Diageo and its shrinking free cash flow? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.